Ladies and gentlemen, good day and welcome to the JTL Industries Limited Q4 FY24 earnings conference call hosted by Nuvama Wealth Management. As a reminder, all participants' line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sneha Talreja from Nuvama Wealth Management. Thank you and over to you, ma'am.
Thank you, Manuja. Good morning all. On behalf of Nuvama Wealth Management, we welcome you all to the JTL Industries Q4 FY24 conference call. We are joined today by the senior management of JTL Industries, represented by Mr. Atul Garg, CFO, Mr. Pranav Singla, Whole-Time Director, Mr. Dhruv Singla, Whole-Time Director. We will now start with the opening remarks by the management, followed by the Q&A. I would now like to hand over the call to Mr. Pranav Singla for his brief opening remarks. Over to you, Pranav.
Thanks, Neha, and thanks to Nuvama for hosting the call. Good morning, everyone. Thank you for joining us today. I'm delighted to welcome you all to the JTL Industries conference call, where we will discuss the financial performance for the quarter 4 year ending financial 24 and for the whole year as well, which will overview of our current capacity expansion and recent acquisition as well. Before we delve into the details of our quarterly results, let me briefly introduce our company to those who may be less familiar. With 3 decades of experience, JTL Industries has transformed into a rapidly expanding company in steel tube manufacturing. Our product lines span various offerings from ERW black steel tubes to pre-galvanized and galvanized pipes, large diameter steel tubes and pipes, solar structures and hollow sections. Our specializations lie in crafting VAP products, focusing on galvanized pipes, ensuring superior quality standards and impeccable finishing across our office. JTL operates 5 cutting-edge manufacturing facilities across India, located to secure raw materials at competitive rates and facilitate our expansion into global and domestic markets. These facilities consist of 3 plants in Punjab, 1 in Maharashtra, and 1 in Chhattisgarh, collectively capable of producing over 1 million tons as a whole. Recently, we acquired controlling stake of 67% in Nabha Steel and Metals, located in Mandi Govindgarh, Punjab. The acquisition provides JTL with ownership of an advanced steel product manufacturing facility. The newly acquired plant boasts a manufacturing capacity of 2 lakh tons and specializes in coil and long steel products such as billets. The strategic move enhances JTL's backward integration capacity, increasing coil production from 1.5 lakh tons at Raipur plant to 2.5 lakh tons and augmenting long product output by an additional lakh tons across Chhattisgarh and Punjab. JTL is set to enhance its production capacity in Maharashtra and Chhattisgarh through a substantial expansion initiative. The initial phase targets rise overall the capacity from 0.6 million tons to 1 million tons by incorporating DFT and traditional forming technologies for manufacturing galvanizing steel tubes and pipes. This move will enhance plant capacity utilization and manufacturing efficiency and diversify our range of valued products to new geographical markets. Regarding our financial performance, JTL has achieved a remarkable milestone by attending its highest ever sales volume, reaching an unprecedented of around 3.4 lakh tons metric ton. This surpasses the sales volume of the previous year, which stood at 2.4 lakh tons, showcasing a robust growth of over 42%. Additionally, JTL experienced a significant raise in the sales of value-added products, with a 35% increase, climbing from 74,000 tons in FY23 to around 1 lakh tons in FY24. Our revenue grew 31% to 2,040 crores in FY24 compared to 1,550 crores in FY23. The company witnessed a significant uptick in revenue attributed to robust demand of products and strategic expansion initiatives undertaken during the year. On the profitability front, we remain committed to gradually increasing the same since EBITDA for the fiscal year was reported at 153 crores with a EBITDA margin which was healthy at 7.5%. The performance was supported by several critical factors, including the increase of VAP share, overall scale of operations, and continuous focus on enhancing efficiencies across all our plants. Turning to our future-looking guidance, we anticipate a 35% growth in the revenue for FY25 compared to FY24, while maintaining a beta metric ton of 5,000 plus for the whole year. Our projected CapEx remains consistent with expectations for the upcoming period. Thank you for joining us today, and I look for an engaging discussion.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitesh Dutt from Burman Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. My first question is I want to understand what is your primary versus secondary mix. And also within secondary, are we manufacturing from patra re-rolling kind of material or sponge iron based HR split HR coil?
What is that? Thank you for your question. So our capacity as a whole in a company is 50% for primary and secondary. So the output for the same for this year was in the same ratio as well. 50% of our sales this year were counted to primary market and 50% was to secondary market. And for making secondary products, we procure billets and re-roll them into narrow bed coils at a Raipur plant. So yes, that's patra, which is the same thing which you mentioned. And for a mandi operation, where we have a capacity of 2 lakh tons, we procure our secondary coils from the local players in the market as well. So that's how we operate our primary and secondary. And for primary, we procure material from JSW and Tata at our Derabasi plant and our Maharashtra plant, each having capacity of 1 lakh tons and 2 lakh tons each, respectively.
Got it. That's helpful, sir. Secondly, I want to understand over the last 2-3 years, has the secondary segment been a big driver of growth for us? Because the secondary prices have been lower than primary steel, and hence there was a market sort of tailwind because of low prices. And also, one of our large listed competitors has been claiming that the market is potentially shifting to primary because number one, consumers' preference for better quality, and second, as the new HRC capacities are coming up, the primary steel prices are expected to go down. So just want your perspective on both of these things, on how you see the market will move, if at all, and how you are prepared to handle that.
Yeah, to answer your question there has always been a primary and secondary market in the majority of the products in India, be it long products such as TMT and say I-beams, girders, channels. So there has always been a primary and secondary divide into the Indian market. As for the ERW pipe segment, it is more of the usages of the product and the gauge of the product which is available for a primary and a secondary option. So in the recent past, where a lighter gauge structure is required for, say, probably your steel gauge, lighter load-bearing structures such as carports, sheds, just a shade shed. So all these applications wherein a lighter gauge steel is required, which from a primary source of product becomes even more expensive with the deltas of thinner gauge. There is the main utility of the secondary product, and with the increase of usage of steel as regards to wood, direct replacement of wood, we've already seen an increase in demand of secondary products in the last few years. That's why we've grown, say, equally in both the segments. Yes, going forward, since we are expanding our product profile, we are going from earlier we used to do only pipes to 6 inches, and by last year we started up to 12 inches. Going forward, we're coming up with a BFT mill, which is essentially a 20-inch mill. So we are going towards a broader product profile wherein, yes, we have to use more of the primary product, so and for different user applications. But it's safe to say that there would be a good demand for the secondary product as well, due to the use case scenarios.
All right. That's really clear. Just last question on this. In the secondary segment, who is your core competitor, right? Are these smaller players, and hence you are able to take advantage of your bigger scale distribution, etc.? And secondly, all the big players, right, at least on the primary side, are putting up huge capacities. So everyone is on the listed side, everyone is increasing capacities by at least 2 times over the next 3-4 years. And demand is not growing at 15-20% CAGR. It's likely growing at 8-10 or low teens CAGR, right? So do you see an overcapacity risk on both the primary and secondary side of the market?
In the secondary market, there are numerous players, and plenty of them are not in the listed space, and they are scattered across pan-India. So it's hard to name a specific person or a specific company. In the primary segment as well, the demand, maybe you forecast that it's in the lower teens because of the whole election scenario and the little demand slowdown. Otherwise, the market has been growing at a rate of 12-13%. And this is what we're expecting, or maybe higher, what we're expecting is going to happen post-elections. And so there's no tailwinds that we are expecting in the market, and it's a growing industry, and the use case scenarios are expanding as well, as Dhruv mentioned. So the industry is, for the primary, secondary, both is growing at a good 13-14%.
So basically, you expect that the incremental capacities that are coming up, for those capacities, there is enough demand in the market to absorb the incremental capacity.
See, when we are increasing our capacity in the market, we are not increasing the capacity in the product profile that we were doing previously, or the same product profile over and over again. So when we are going forward, we are focusing more on value-added products, which open up more space and more markets for us to venture into. For example, DFT will open up newer export markets for us, newer markets for structural applications, for multi-story buildings for us. So what we essentially are doing is not following the herd and just putting up capacities into the same black pipe manufacturing up to 3 inches or 4 inches, which is the lowest strata of the value chain of Yadul pipes. So that is not what we are aiming for. We are aiming for an increase in our product profile by increasing our size range and value-added products. So even if there is multiple capacities being installed in India, there are only couple of players who are doing it in a value-added segment, rather than more of the players are going into the commercial grade pipes for volume increase.
Thank you. That's helpful. I'll come back in the queue. Thanks for it.
Thank you. The next question is from the line of Pradeep Rawal from Yogya Capital. Please go ahead.
Yeah, thank you for the opportunity. So my question is regarding the abnormal fixed asset turn that we generate right now. Can you shed some light on it?
Can you please repeat the question?
Yeah, my question is regarding the fixed asset turn. It's quite high right now as compared to industry peers. So can you shed some light on it?
Yeah, thanks, Pradeep, for your question. So our asset turn was extremely high because the mergers and acquisitions that the company has done in the recent past have been on a book value. Whatever applications the company has been doing in this year, if you look at our gross block as well, which has increased from around 90 crores to around 150 crores. So this is getting our asset turn down to 14-15 from levels of 18-19 before. So this is a gradual shift which will happen over time, and as the assets will sweat as well, you see the number coming properly as well. This year as well, we are expecting to deploy close to 150-200 crores on CapEx. So hence our gross block will come down, our asset turn will come down further to 12-13 numbers, which will be similar across industry. It's just that previously, whatever asset purchase we did for the Mandi plant and the merger we did was on a book value. So hence the asset terms seem bigger right now.
Okay. So my second question is regarding that you have regarded that we will outgrow our competitors, like we can expand our market share from 9% to 25%. So can you what gives you confidence to outgrow our competitors? What is our edge?
So if you look at our numbers for the whole financial year, we've done a tremendous 40% growth over the last financial year. This has been done because we have been adding more SKUs and gathering more market share from our competitors. The forward-going approach would be that we'll be adding more SKUs itself as well and circulating the same product in the market. Plus, that we are a debt-free company. This gives us the encouragement and confidence to make the pricing comfortable according to us and playing with the margins as well. So hence, growing and expanding and increasing the VAP share is easy for us because of the debt-free status.
Okay. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of CA Garvit Goel from Invest Analysis Advisors. Please go ahead.
Hi, good morning. Am I audible?
Yes, sir.
Yes. Yeah. My first question is on the industry side. Do you witnessing any kind of slowdown happening at the industry level due to these political events going on?
Thanks, Garvit, for your question. We don't see any slowdown in the industry because of the scenario what is happening. Obviously, this quarter we faced a little slowdown because there were no government demand as such. But apart from that, after the elections are over, we expect the demand to pick up again because the missions where we supply products, it's a basic demand for the country and this mission is bound to happen, Jal Jeevan mission. No matter which government comes or how elections turn up, this is the kind of industry where we cater is very safe. And apart from that, we don't have our major sales happening towards this sector. Around 20% of our sales is towards government sector and the rest is towards dealers and exports. So we always prefer to maintain a healthy mix of supplies. So whenever there's a slowdown in one kind of industry, we can at least cater the other industry a little more.
And secondly, on your value-added mix, it is also improving in the terms of absolute numbers, but your value-added mix in terms of percentage are not getting improved. So what is the reason for that?
So if you understand to get the valued products into production, the first step is to increase the black pipe production. Because till the time I won't have black pipes, I can't make galvanized pipes. So adding galvanized tanks is something that I've been doing every now and then in every quarter. But the major outflow would be happening when all my galvanizing tanks are commissioned. And going down the line, I'm adding GL line, color-coated line, DFT structures, this year itself, in which as a whole, the VAP share should be increasing altogether.
So, like you mentioned, this year we are targeting 5,000 tons of EBITDA. So, what is exactly that is giving you the confidence to reach to that number, considering the kind of EBITDA per ton that we are currently doing?
So right now, the products that I'm offering is galvanized pipes and back pipes. Going down the line, when I'm talking about adding my VAP products, I'm adding products from GL line, color-coated line, and DFT. These products are valued from day one itself. So, and these products have a EBITDA per ton in the higher 7,000, 8,000. So once these products come into production and I start supplying in the market, these products from day one are value added and will obviously show increase in the EBITDA per ton.
So are the products going to start contributing to the revenues from this quarter only or the upcoming quarters?
No, not this quarter. You should start expecting everything to be commissioned, talking about DFT in quarter 2, and from H2 you should start looking at the proper numbers. We'll obviously hit a trial phase of DFT in H1 itself, but the proper numbers and efficient manner would be visible from H2.
Understood. And are the people also, previous participant also asked about the incremental supplies taking over the demand. Is there any real fear of oversupply in this industry going ahead?
Can you please repeat the question? You were not audible properly.
Is there any kind of fear in terms of the oversupply of in this industry going ahead, considering the plans of your peers as well as plans of JTL Industries?
As we mentioned before, that we venture into adding more SKUs every, when we're expanding, we are adding more SKUs. If we were just adding the same product, then it would be a fear for us. But as we are diversifying ourselves and adding more SKUs in every growth phase that we are conquering, so this fear is not anywhere close to us, and these products that we are adding are fully value-added from day one itself. So there is no fear as such that if we see a slowdown or there's oversupply in the industry for our products.
But you are saying these products are value-added, but value-added products are also manufactured by the peers as well. No? That is why I'm asking this question.
The DSP products are not manufactured by a lot of players in India right now. We'll be essentially the second one in India to get this technology. So there's a lot of humongous demand for the product, which we'll be supplying. There are not many players of us who do DSP products.
Okay, fine. That's it from my side, sir. All the rest for the future.
Thank you. The next question is from the line of Dhananjay from Ask Investment Management. Please go ahead.
Hi, congratulations for a good set of numbers. Just wanted to ask you a couple of questions. A, how much is the total capex we're doing for the next 2-3 years? And B, what is the update regarding the warrants and how are we looking in terms of the inflow of the warrant money?
Hi, Dhananjay. Thanks for your question. So the total outflow the company expecting in capex this year is close to 150 crores plus. And if you talk about the next 3-4 years, we'll be spending close to 500 crores plus, 600 crores plus in the coming 2-3 years.
Okay.
Giving an exact figure would be tough right now because it's a phase-wise manner enhancement. Yeah. And if you talk about the warrants, the promoters pitched in some money as well in the previous quarter. Around 170 crores is what 675 crores is what totally promoters signed up for, and out of that 170 crores is what we already received in the company as well. And the other warrants are the warrants that we did before are due in September. So we expect everything to come before that. Around 170-180 crores is something that we are expected to get from that.
Okay. Perfect. I've heard the remaining questions. Thank you so much.
Thank you. The next question is from the line of Aditya Velekar from Axis Securities. Please go ahead.
Thank you for this opportunity. Specific questions on capacity expansion. And so in FY25, we assume 1 million ton to reach the target of 1 million ton. And then for FY26, how much capacity expansion you expect? And also, if you can outline the sales volume guidance for 25 and 26.
Thank you for your questions. So yes, we will be reaching the capacity mark of 1 million tons before the year ends. And the guidance that we mentioned for this year is a 30% upward shift over this year. And as our capacities keep coming up every now and then every quarter, we keep updating our guidance towards upward section as well, and try to do better as well. And if you talk about the guidance for the next year, we should be again doing a 30% growth minimum for the next 3-4 years.
Okay. And you have mentioned 600 crores capex in coming 2 years, right? If I heard you correct.
It's 2-3 years, not to give an exact number, but around 2.5-3 years is something that we can expect everything to outflow.
And your plan for 1 to 2 million ton expansion means that will be contingent upon the funds available, means raising of funds, right? And any color you want to do on that are we on track for 1 to 2 million ton expansion, and by when you envisage that that will also flow through in the longer term?
Yes, there's no struggle that we're saying in expanding from million tons to 2 million tons. The company has been growing its margins and recently increasing its profit as well, net profit as well. So if you talk about the whole scenario, the promoters also helped in by putting in some money as well. So altogether, the company is a very comfortable cash situation right now for the future growth, and there's no stress as such we see for the coming months. So, and as and when the company requires money, the promoters are flexible to put in the money that time as well. So there's no agenda that we have made that we'll be putting in money the last day or last something or the other. As and when the company requires money, the company has adequate money right now. But as and when the company will require money, maybe for advance to the suppliers or to order the advance of machinery, we keep putting the money from promoter side itself.
Okay. And on with regards to demand, so in this first half of this fiscal, do we expect some softness in demand because of the elections and all, or you expect that the demand will pick up only from the second half? Any color on the demand pickup?
So we're expecting our obviously the demand should pick up enormously by H2, but our H1 should be strong as well, and we should try and give new all-time high or new all-time high in every quarter.
Okay, fair enough. Thanks for this opportunity. Thank you.
Thank you. Ladies and gentlemen, in order to ensure the management is able to address questions from all the participants and the conference, please limit your questions to 2 per participants. If you have a follow-up questions, we will request you to rejoin the queue. The next question is from the line of Bhavin Pandey from Trust Plutos. Please go ahead.
Hi, congratulations, Pranav, on great set of numbers and the wonderful you guys had at JTL. First thing, so this acquisition of Nabha Steel sort of takes me back to the previous interaction we had, where the key moat cited was the backward integration to the core that helps company sort of generate economies of scale. So could you just shed light on this, both economically as well as if you could quantify the effects of this acquisition, it would be of great help.
Thanks, Bhavin, for the question. So this acquisition of Nabha Steel will help us basically expand our margins. Right now in a mandi plant, we procure around 1.5 lakh tons material, 1.2 lakh tons material from secondary players who are locally available and supply the product of secondary coil. Having the acquisition of Nabha Steel, we'll in-house make the coil itself, and this will be from scrap. So effectively, we should be like on a black type right now, if you're making close to 2,000 rupees, 1,500 rupees EBITDA per ton. So it should be at least 30% more saving on increase in the EBITDA per ton on the black type itself. So it is yet to start. It'll take a quarter or 2 or maybe 2 quarters as well right now for the final production from Nabha Steel to start, because we're making some changes in the capacity right now. But once everything is set, you can see a significant increase in the bottom line.
Okay. Oh, that's wonderful. Secondly, Pranav, on inventory front, the days inventory in hand has declined. So any just sort of reason that could be attributed to it?
Can you please repeat the question?
Yeah. Inventory days have declined on a year basis for FY24. So any reason for that?
So basically, since we are not into the business of manufacturing steel, we are just converting steel. So we tend to make ourselves more leaner when the prices go down and material availability is robust. So and vice versa, when the material availability is not frequently available, then we have to stock up. So these are the reasons. Last year, there was a good correction in prices, and we were able to also move out our finished goods on a timely basis. And that's how we also tended to increase a little bit in our market share. to have timely deliveries, increase in our product profile. So these are the reasons that we